I'm Martin King, analyst at Edison Investment Research. We're here to talk about international public partnerships, or INPP, and I'm joined by Chris Morgan, who's Senior Investment Director at Amber Infrastructure, the investment advisor to INPP since it launched in 2006. As an established, well-resourced specialist asset manager, Amber has been core to the success of INPP, and I know Chris will want to talk a lot more about that. INPP itself invests in a diversified portfolio of global public infrastructure assets with a focus on availability and regulated revenues. Its aim is to provide investors with consistent and predictable long-term inflation-backed returns, whilst also delivering environmental and other benefits to those who use its assets. Chris, thank you for joining us. Could we perhaps start, before we go into INPP in more detail, could we perhaps start about the place of infrastructure investment, and particularly listed infrastructure investment for investors?
Yeah, of course, and thanks for having me. I guess infrastructure more generally is the physical asset structures and systems that enable daily lives to operate. And an investment in infrastructure is generally characterised as one that is defensive and resilient across economic cycles. Now, the asset class more generally emerged in the 1990s, and what we've seen more recently is a broadening of what is categorised as infrastructure. So there is now a greater range of assets that's defined as infrastructure than once was. And what that's meant is that we've seen the emergence of different investment strategies that target different parts of the infrastructure sector and ultimately provide investors with differing risk-return profiles and a different balance between yield and capital growth. Now, international public partnerships, or INPP, listed on the London Stock Exchange back in 2006, as you mentioned, and its focus remains on the lower end of the infrastructure risk spectrum. So it's focused on what is typically referred to as supercore or core infrastructure assets. So INPP is really focused on the original thesis for investing in infrastructure, delivering predictable, consistent returns to investors, and that's because its assets are underpinned by long-term contracts with government or government-backed entities. Those contracts have built-in inflation protections or a high degree of inflation linkage within the contract, and ultimately a lower correlation to the wider market than what you might get from traditional asset classes such as public equities or fixed income. So I suppose to me, those are the key benefits and attractions of investing in infrastructure. And being able to do that in a listed way means it's a very easy and liquid way for investors to access those characteristics and make sure that infrastructure is part of their broader, diversified investment portfolio.
Chris, can I get you to go into a little bit more detail on the company itself, the investment strategy, the sorts of assets you invest in?
Yeah, of course. And the focus for the company is really on investing responsibly in social and public infrastructure assets that generate long-term benefits for all stakeholders. And when I say that, I'm referring to predictable and consistent financial returns for investors, as well as environmental and or social benefits for individuals or communities that are served by our assets. And really, we achieve those aims by investing in essential, low-risk public and social infrastructure assets that are generating, for the most part, availability-based revenues. So those are revenues that are availability-based. They're not linked to the usage of the asset. The revenues are paid to us by government or government-backed entities. So they're not only predictable, but highly secure because of the creditworthiness of the counterparty. We have built-in inflation linkage. So within the underlying contracts, it will explicitly stipulate how and when the revenues are adjusted to reflect prevailing inflation. And we use very robust capital structures whereby we have a very low sensitivity to the impact of rising debt financing costs on equity returns. Now, the fund over the last 16, 17 or so years has grown significantly. Market capitalisation is currently around $2.5 billion, and we're invested in more than 140 different investments. They're diversified not just geographically, but also in terms of the counterparties that we use on our projects and businesses, and also the nature of the assets. So we've got sort of traditional social infrastructure assets such as schools, courthouses, police headquarters, or libraries, through to rail assets or energy transmission or distribution assets as well. So a real range of assets, but fundamentally they are all helping to facilitate the delivery of essential public services. It's worth perhaps touching on the manager, so Amber Infrastructure, the company I work for as well. That's a business with around 170 employees. There are perhaps a couple of key points to draw out. One is the asset management team that we have within Amber. So that's a team of around 40 to 50 people. We have people on the ground in all the jurisdictions in which INPP is invested, and their role is to make sure that the assets are performing operationally for the users, but also financially for investors. So they're making sure that all of the counterparties are meeting the contractual obligations within the underlying documents. That's a team of people that have varying degrees of experiences, backgrounds. They know the assets they're responsible for very well. And I think having that team in-house within Amber is really testament to the importance that INPP places on actively and responsibly managing its assets. And I think perhaps the final point is around the fact that the consideration of environmental, social and governance factors is embedded within the investment advisor. So you would have seen that INPP is aligned with various different regulations and frameworks in order to demonstrate the environmental and social benefits of its portfolio. But having the consideration of environmental, social governance factors embedded within the business strategy of the manager, I think is really important to make sure all parties are aligned.
Chris, since the company was formed in 2006, it's been through a number of challenging market conditions, and it always seems to be the case. Can you talk about how the portfolio has performed during that period?
I think it's fair to say that the portfolio has been very well tested over the last 18 years. Relatively shortly after the fund was launched, we saw the global financial crisis. We then saw Brexit, global pandemic, international wars that have obviously interrupted on certain supply chains. We've had a volatile macroeconomic conditions. We've actually had a period where we had deflation. More recently, we've had a period where we've seen double-digit inflation. Interest rates have obviously increased relatively significantly in the past couple of years. They're not necessarily high relative to historic standards, but certainly a lot higher than what we saw between sort of 2010 and 2020. But throughout that period, the fund has continued to perform very well from an operational perspective. And also from a financial perspective, we've continued to pay growing dividends to our investors every year. That's 16 years of consecutive dividend growth, which is something that we're really pleased with, we're really proud of, and something I believe sets us apart from our peers. In terms of how we've performed so resiliently, I think that's based on ultimately the characteristics I mentioned at the start of this discussion, which was the predictability of our revenue streams, the security of those revenue streams given the counterparty, the inflation linkage within our contracts, and the robust nature of the capital structures that we've implemented. I think if we then focus in on the last couple of years where we've seen higher inflation and higher interest rates, we've continued to pay that growing dividend. As I mentioned, we've continued to perform very well. And that's really because of the inflation protection we've got in the underlying documents, and the fact that we have very limited sensitivity to rising debt financing costs because the debt is ultimately fixed or swapped, or we're in a regulatory framework where the regulatory framework provides for greater revenues in the event that the market cost of debt increases. And I think the fact that the portfolio has been so well tested over the last 18 years gives us a great deal of confidence in terms of the future performance of the assets.
Chris, despite that strong track record of performance, it's not been reflected in the share price in the last couple of years. And to a very large extent, that's a sector phenomenon. The whole sector has been derated. But what do you see as the main drivers of that derating for INPP, and what can the company do to combat it?
Yeah, I mean, you're right. It is a sector-wide issue. What we've ultimately seen over the past couple of years is rising inflation and interest rates have resulted in investors either withdrawing capital from the sector or reallocating capital to a different asset class. That's an issue that's affected not just INPP, but the wider listed investment trust sector. It's not reflective of the performance of the portfolio, as you said. It is an external factor that is not within our control. And I think the resulting share price, where we are today, materially undervalues the company. As an example, if you look at the projected net returns available from investing in INPP at the end of February, that was implying net returns of close to 9.5%, which was significantly in excess of what was available from investing in a UK government bond. So we believe very attractive returns are available because the share price currently materially undervalues the company. In terms of what we can do about it, it may well be that it is outside of our control and we can't fully remedy the position, but what we have tried to do is take a number of actions that are designed to ensure the fund is as well positioned as it possibly can be. So we've increased our dividends, and that's to allow investors to tangibly benefit in the higher inflation that we've seen, therefore the higher cash flows that we've generated because of that inflation linkage within our contracts. We've disposed of assets to demonstrate that the valuations are robust, and in order to allow us to recycle capital to make sure it's working as efficiently as possible for investors. We've paid down our corporate debt facility. So that's a facility that many across the sector have. It's a floating rate facility that's been used historically to efficiently finance acquisitions. But obviously it's become more expensive to use recently, and then we've prioritised paying down that facility. And as we are today, it's fully paid down. And then we've also announced a share buyback programme because we recognise that with the shares trading where they offer a very attractive investment opportunity for us. And with surplus capital being available from one of the sales that we completed towards the back end of last year, we decided to allocate 30 million to a share buyback programme. So we have announced a number of measures. We have not said that's it, we're not going to do any more. We continue to actively monitor and manage the portfolio. We continue to maintain a prudent use of our corporate debt facility, and more generally maintain a disciplined and transparent process in terms of allocating capital.
So, Chris, bringing all that together, can you talk a bit about the outlook and also the areas that you're focusing on within the portfolio?
Yeah, I think the outlook is very positive. Our focus at the moment is on maintaining and, where possible, enhancing the financial, operational and ESG performance of our existing assets. We don't need to make any additional investments in order to deliver on current projected returns, but I think there will be a lot of investment opportunities available to us going forward. I think that will be across the geographies in which INPP is invested, and I think it'll be driven by various factors: the need to drive economic growth, meet decarbonisation targets, ensure we have climate resilient assets, and to repair and upgrade existing but ageing infrastructure that we have. And I think in terms of the amount of capital available, I don't think it's necessarily feasible that all of that capital will come from the public sector. So I think there will be a key role for private capital to play. Now, we have a large origination team within Amber, and it's got a lot of experience and a strong track record of delivering accretive investments for the fund. So I think we're very well placed to take advantage of what I think will be a fulsome investment pipeline going forward. Now, having said that, we've obviously stated our approach to reducing the use of our corporate debt facility, and therefore the extent to which we find additional attractive investment opportunities, we'll need to make sure that they can be met by recycling capital from the existing portfolio. So we will maintain that disciplined and transparent approach to capital allocation. But the first part of your question was around the outlook, and I think the outlook is very positive. I think the existing portfolio will continue to perform very well as it has done historically, and coupled with the fulsome investment pipeline going forward, I think means INPP is a very attractive investment proposition.
Thank you very much, Chris.